paper. All right? And I think this week you will know your examination date, right? Is it this week? Huh? 27th. So which is tomorrow, right? So tomorrow you will know your examination date. All right? So please find your examination date. Do you remember at the beginning of the trimester, I give you the unit planner, right? At the end of the unit planner, write down your examination date. So you know exactly when is your exam. Okay? All right. A quick recap. Last week, we talked about risk and return, the second part. We talked about how to use the risk-based approach to estimate the expected return. Step one, we're trying to measure the systematic risk. We knew that we are not able to work out the systematic risk directly. To this end, we decided to use beta. We set the market beta equal to 1. We then work out the systematic risk of any underlying financial asset based on the systematic risk of the markets. It is a relative risk measure. The risk of the asset relative to the risk of the market. Once we work out the systematic risk of the asset based on historical data by using regression, we then able to estimate asset expected returns based on your information, your analysis, your opinion about the future market condition. And that is the risk-based approach. And then we talked about how to calculate portfolio return and risk. And then we've talked about capital asset pricing model, the first risk-based asset pricing model that can help us to calculate expected return. Please note that expected return, cost of equity, required rate of return, they are the same in this unit. They are interchangeable. For example, expected return is from shareholders' perspective. It's shareholders' expectation about the return of the equity, right? Cost of equity is from the manager's perspective, the cost of using the equity. Manager trying to meet the shareholders' expectation. To this end, shareholders' expectation is manager's obligation. It is their cost of using equity. Does this make sense for you? That's why they are the same, interchangeable. And similarly, required rate of return, same as cost of using equity. They just have different name under different context. Students used to come to ask me, "Hey, Robert, to this end, if they are the same, why we have 3 different names?" Because in this unit, they are the same, but in practice, they are slightly different. We do have tax implications and other factors. So the value could be slightly different. But in this unit, they are interchangeable. Okay? To this end, capital asset pricing model can help us to work out the expected return. It is a method to help us to estimate cost of using equity. All right? Okay. What about this week's topic? After studying this topic, you will be able to describe the ideal characteristics of the capital budgeting technique. Identify 6 different techniques that can be used to evaluate capital expenditures. 6 different techniques that can be used. All right? These 6 methods are the payback method, the discounted payback method, the accounting rate of return, the net present value method, the internal rate of return, and the profitability index. Where payback and discounted payback apply the same methodology and approach. Accounting rate of return is more like an accounting method. NPV, net present value, internal rate of return, profitability index, considering the risk factor. Okay? And finally, for each of those approaches and methods, we will discuss the advantage and disadvantage of each of them. Okay? Capital budgeting is all about what is capital budgeting, investment decision making, analysis of potential project, A, B, C, D, E, F, G in front of us. And then long-term decision involves large expenditure. We have 6 projects in front of us. We have limited capital in our pockets. We have to make an investment decision. To this end, this is very important to firm's future. For example, last week I gave you an example about Nokia and iPhone. Nokia decided not to invest in smartphone, and that is a very bad investment decision, right? So you think about investment decisions, that's how it looks like. You have projects in front of you, investment opportunities in front of you. You have to make your decision. And then steps in capital budgeting. Step 1, for capital budgeting investment decision, you always need to estimate future cash flows. You have to have a reasonable estimation about your future cash flows, your projected cash flows. Without a reasonable estimation about projected cash flows, you can't make any investment decision. You have to know what will you have in future to make your decision, right? You have to estimate cash flow, both inflow and outflows. You have to assess the risk of the cash flow. For example, there are two different projects. The first one may give me higher cash flow, but with higher risk. The second one may give me lower cash flows, but with lower risk. So you have to assess the risk factor as well. And then, once you assess the risk factor, you have to incorporate the risk factors into your cash flow analysis. How? Discount the risk factors. Discount the cash flows. Am I right? So discount the cash flows by the risk factor. To this end, you are able to incorporate the risk factors into cash flow analysis. Finally, you need to evaluate the cash flow. Evaluate the cash flows after discount. And that's the general idea about capital budgeting process. Up to this stage, any questions? Okay. Now, in this week's topic, generally speaking, in practice, as a financial manager, if you are the manager of the company, you prefer, first of all, your preference. The approach must be easy. Easy to apply and easy to understand. If you, from an econometrician point of view or from the economics point of view, they are always to give you many different models for forecasting, stuff like this. But these models, equations, are very hard to apply and understand. To this end, preference from manager's perspective, easy. Manager only consider cash flow because cash flow matters. For investments, you have to use cash flow to make investments. You can't use account receivable to make investment. You can't use your revenue to make investment. It must be cash flow. Managers, they recognize time value of money. Managers, they are not stupid. They consider risk. For example, two cash flows. The first one is $10, but in 1 year's time. The second one is $100, but in 20 years' time. You have to consider the time value of money. How? Discount the cash flow to times 0. And then compare the cash flow at the same point of time. In this case, you capture the time value of money. You also capture the uncertainty of the cash flows, risk. Managers, they fully account the expected risk. For example, two projects. The first one have $10 cash flow in 1 year. The second one have $15 cash flow in 1 year. However, the first one is in retail business. The second one is in mining business. Higher risk. Higher risk, you have to consider the risk factor, higher uncertainty. So the discount rate must be higher for the mining sector. Am I right? So in this case, you will have two different discount factors for these two different projects, even though both of them happened in a year's time. Finally, the managers will then make a decision, and based on their estimation, always their estimation, it could be right, could be wrong, they make their decision. They will go for the one that they believe that have the highest value. Up to this stage, any questions? In this week, we will learn 6 different techniques, and we will use one example for all of these 6 techniques, which is this one. So Global Untethered is a worldwide provider of wireless telephone. Basically, there are 2 different options in front of them, investments. Those 2 investments are mutually exclusive. Mutually exclusive, which means you go A, you can't go B. You go B, you can't go A. That's it. You can't go both of them. All right? In most of the cases in practice, projects are mutually exclusive. Why? Because of the budget constraint. You only have a limited amount of money in your pocket. Get it? You can't go for both of the projects in practice. It's like property investment. In most of the case, you have 2 properties in front of you, you can only select one of them, right? All right. These 2 projects are Western Europe and a smaller one, Southeastern Australia. So the cash flow of these 2 projects looks like follows. If you do have a slides, you can read about it. If not, I will read the number for you. That's okay. All right? So the one in the top is the Western Europe project. For the Western Europe project, it's like your initial investment is 250 million. So initially, if you invest 250 million, in the next 5 years, in year 1, you will receive 35 million, year 2, 80 million, year 3, 130 million, year 4, 160 million, year 5, 175 million. The second project is the Southeastern Australian, at the bottom. At the beginning, it's a much smaller project. You invest 50 million. And then, in year 1, you will receive 18 million, year 2, 22 million, year 3, 25 million, year 4, 30 million, and finally, 32 million. So 5 cash flows for each of these projects, 2 projects. And then you need to make your decision. As you can see, the first one, initial investment, 250 million. Second one, much smaller, only 50 million, right? So let's make our decision, and let's see how should we make our investment decision. So you have 2 projects in front of you. Now it is up to you to make your decision by applying the knowledge we learned before. Okay. These 6 methods, generally, the first 2 about payback. Now, what is the payback method? Or what is the payback period method? Very easy. Payback period method is the simplest method to use. And it is very practical in practice. It's just measuring how long does it take to get your money back. And that's payback. How long does it take to get your money back? If your initial investment is 50 million, how long does the project take to get my $50 million back? And that's the payback method. For the payback method, what's the decision rule? The decision rule is the shorter the payback, the better the project. You go for the one that gives you shorter period of payback. Does this make sense for you? That's payback method. Now, payback method do not consider discount factor. To this end, since it's not risk and time value of money, we then have a more complex version called discounted payback. But in principle, they are the same. Still matters how long it takes back to get your money back. But now we consider present value and future value. And then we move to an accounting method called accounting rate of return. It's focused on the accounting profit only. And then we move to net present value, internal rate of return, and profitability index. Now, let's start from the first one, payback. This method is very simple, but this method is very practical in practice. The payback method is the amount of time required for the company to recover its initial investment. Think about my example. Today, I invest $10 in this project. Year 1 cash flow $1. Year 2 cash flow $9. Year 3 cash flow $100. How long is the payback? I invest $10 at the beginning. Year 1 cash flow $1. Year 2 cash flow $9. Year 3 cash flow $100. How long is the payback? Only takes me 2 years to get my money back, right? Okay, second project. Today, I invest into this project. Year 1 cash flow $1. Year 2 cash flow $1. Year 3 cash flow $1,000. How long does it take? More than 2 years, but less than 3 years. Am I right? That's it. That's about payback. Now, how do we make an estimation? The first one, you will get your initial return back in exactly 2 years. But it looks like the second one, we knew that there is a range. The payback is more than 2 years, because at the end of year 2, you only get your $2 back, right? But less than 3 years, because at the end of 3 years, you have much more than your initial investment. So how to do the estimation? Very easy. If the project payback period is less than your targeted payback, you accept it, otherwise you reject it. Let's see how to do the calculation. Okay? All right. In our example, the global untethered, management, they will set up a cutoff date or cutoff period. Management payback cutoff is 2.75 years. What does that mean? That means for many, many different financial reasons, for our company, we have to get our money back within 2.75 years. And that's the meaning of cutoff. In practice, this is very important because in most of the case, you will finance your project by using bank loan, right? Debt. If you borrow money from the bank, in most of the case, you have to repay your bank loan or debt within a certain number of years. Am I right? You have your debt obligation to meet. To this end, highly likely there will be a cut-off time. For example, today, there are two projects in front of me. Both of them initially requires $10. The first one, year one cash flow $10. Year two cash flow $2. That's it. The second one, year one cash flow $1. Year two cash flow $1,000. If you only look at this project, looks like the second one is much better. Am I right? However, the payback for the first one is only 1 year, but the payback for the second one is more than 1 year. Am I right? What about at the end of the year, you have to pay your debt to the bank? What about if at the end of the year, you have to meet your debt obligation? If this is the case, you have to go for the first one. Am I right? No matter how attractive about the cash flows of the second project in the second year. Because you have to meet your legal obligation. Does this make sense for you? That's one of the reasons company will normally have a cut-off time. Another reason company will have a cut-off time is because of the uncertainty. The longer the project cash flows, the higher the uncertainty. No one knows about future economic condition. As I said, today, if you are a very experienced manager, you may have a very reasonable expectation about cash flows in next year, right? But no one can guarantee that you will have a good expectation about cash flows in 5-6 years' time. Because we have no idea about the future economic condition. Do you agree? I'll give you guys another classical example. Just last week, Australia, we have another new prime minister. This is our 6th prime minister in 7 years' time. But when I first came to Australia in 2003, we are in the Howard government. And Howard, or John Howard, is in the prime minister position for 11 years. So if you standing at that point of time, and if you look forward about future, you have no idea about this political environment. You may have an expectation about future cash flow in 1 year, but how could you have a reasonable expectation about cash flows in 7 years' time? To this end, the longer the expectation, the longer the project, the higher the uncertainty. That's another reason we need to have a cutoff. Normally, we set our cutoff within 3 years' time in practice. Does this make sense for you? So we set up a cutoff. Now, let's look at these two projects. Let's think about which one should we go for. The first project, initial outflow is 250 million, right? Its initial outflow is 250 million. Let's look at how it looks like about its cash flow. In these slides, we have the cash flows of the first project. Year 1, 35 million. Year 2, 80 million. Year 3, 130 million. Year 4, 160 million. Now, let me ask you a question. At the end of year 3, if you look at the table, how much is your cumulative cash flow? Huh? At the end of year 3, how much is your cumulative cash flow? Cumulative cash flow means total amount of cash flow for the first 3 years. How much is it? 245 million, am I right? Question, how much is your initial investment? 250 million, right? Is it enough to recover your initial outflow? So your payback must be more than 3 years. Do you agree? Because it takes more than 3 years for you to get your money back. Am I right? Okay. At the end of year 4, how much is your cumulative cash flow? 405 million, am I right? Is it enough? More than enough. To this end, now you know your payback is more than 3 years, but less than 4 years, between 3 to 4 years. Now, how to make the calculation? Very easy. The payback period is equals to 3 years, the number of years before your payback, plus the remaining cash flows. At the end of year 3, you have 245 million. Do you agree? you need another 5 million to recover your initial cash flow. Do you agree? Am I right? But in year 4, just in year 4, it will give you 160 million, right? You need to work out the fraction, the proportion of that year, which is equal to 5 divided by 160. Do you agree? And that's how to work it out. So you need another 5 million in year 4, but in year 4, in total, it gives you 160 million. You need to work out the proportion, you need to work out the fraction of that year is equal to 5 divided by 160. Does this make sense for you? So the total amount of payback will be 3 years, number of years before you fully recover your cash flow, plus remaining amount of cash flow, 5 divided by 160, which will be 3 and 03 years. Any questions about the calculation of payback? Please note that in examination, I do not have an equation for payback because there's no equation for such a thing. I used to have students ask me, Robert, why we don't have an equation for this? Because I don't know how to write down an equation for this. This is more like conceptual, all right? You need to understand it. It's just equal to number of years before payback plus the fraction of the years in that particular year. Does this make sense for you? So 3.03 years. So how long is your cutoff period? 2.75 years. Then what should you do? For the first project, what should you do based on the payback? You have to reject the project. No matter how attractive the project is, you have to reject it. In practice, payback is very practical because, as I said, if 2.75 years you made your decision based on your debt obligation, that is the time that you have to meet because this is your legal obligation. If you can't get your money back within that period of time, bankruptcy, insolvency, am I right? So you have to make sure that you meet the time period, you meet the cutoff period. That's the West Europe project. Unfortunately, we have to reject it. But what about the Southeastern Australian? What about the Southeastern Australian? For Southeastern Australian, what happened? How much is your initial investment? 50 million, right? Year 1, 18 million. Year 2, 22 million. Do you have enough money for the first 2 years? Cumulative cash flow, 40 million. Am I right? Now, let's see about year 3. At the end of year 3, how much is your cumulative cash flow? 65, right? More than enough. So your payback must be more than 2, less than 3. Okay, which is good. Now let's work out your payback. More than 2, which means the year before you fully recover your cash flow, number of years is 2 years. At the end of year 2, you recover 40 million. You need another 10 million, 50 minus 40, right? To fully recover your initial investment. Do you agree? But in year 3 gives you 25 million. Do you agree? You only need 10 million to fully recover initial cash flow. Year 3 gives you 25 million. Assume cash flows equally distributed across the year. To this end, the fraction of the cash flows or number of years to recover your initial investment will be 10 divided by 25. Am I right? To this end, you need 10 million at the end of year 2 to fully recover your initial outflow. And for year 3, you have 25 million. To this end, your payback will be 2 plus 10 divided by 25, which will be 2.4 years. Any questions about the calculation about this? Any questions? Can you do it? Very good. Now, how long is the cutoff? How long is your payback? 2.4. According to the decision rule of payback, what happened? You should accept this project. To this end, for the first 2 investments, if we use payback method to make our decision, we should go for the second one. Up to this stage, any questions? Any questions? Very good. Now, if you don't have any question, I would like to ask you some question. First of all, without looking at the slides, in your opinion, what is the best advantage of using payback? Simple, right? And it makes sense. in most of the case, it meets our expectations in practical. It makes sense. Payback, in my opinion, yes, it is simple. But payback, in my opinion, is one of the best methods for you for decision making. It is very, very important. But there are many disadvantages of payback. So what are the disadvantages? How do you think?
It doesn't consider future benefits after the
Very good. It simply ignores future cash flow. Like I said, if you have two projects, the first one, initial investment $10, year one cash flow $10, payback only 1 year, right? Year two cash flow $2, that's it. The second one, initial investment $10, year one cash flow $1, year two cash flow $1,000. According to payback, you go for the first one. It does not consider cash flows happened after the payback, because it only considers how long it takes you to get your money back. To this end, it could be one of the major limitations of this method. Short-sighted, am I right? But in practice, in most of the cases, you don't have a lot of choice. You have to meet various different kinds of obligations. And of course, as another example I said, you may have a lot of cash flows after the payback, but what about the uncertainty? Who knows? There's no one can guarantee that you will have a very good estimation about cash flow that happens in 10 years' time. No way, all right? If you ask the craziest guy in the world at 2008 to predict about the Prime Minister in Australia, no one will tell you that in the next 10 years we will have 6 Prime Ministers. That's impossible. You're not going to believe in this as well, am I right? But that's what happened. So we don't have any reasonable expectations about future if we have a longer time period. It's really, really hard, okay? What are other limitations for payback? There's still one more major limitation. There's many limitations, but still one more major limitation. Huh?
It doesn't say the exact period, like when we are getting the
Oh, the cutoff is based on management. As I said, the cutoff is based on management experience and management's the company's requirements. But what is the another major limitation? That could be one of the limitations. I'll come back to that. But there's one more major limitation. Very good. It does not consider risk. We do not consider time value of money. We simply have the cumulative amount of cash flow, am I right? We do not consider time value of money. And he's right. Another limitation could be the cutoff. The cutoff period is really hard to say. It is really hard for you to determine a right cutoff period. In most of the cases, in practice, we determine the cutoff period based on our debt obligation, because it's pretty clear you have to, right? But
it doesn't say the exact payback period.
It doesn't say what?
Exact payback period, like in the earlier case, you said like it's between 2 to 3 years.
Yes.
But we don't determine the exact payback period at what time we are getting.
But that's what we calculated. We calculate the payback.
Like, it's like doesn't come like with an exact period, like it's more like it's like decimals.
Okay, it's not like in, oh, you mean it's not in whole years or something? No, that's not a limitation. That's okay. 2.4 years is like 2 years and 3 months, or 2 years and 4 months. So I don't think this is a limitation, though. The cash flow? Okay, that could be a reason. But in this one, for payback, in most of the cases, we assume the cash flow is equally distributed. Yes, that could be a reason. So in that particular year, you may not know when will the cash flow comes out. That could be a limitation. Any other limitations? Because it's ignore cash flow after payback, it's ignore the risk factors. In most of the case, it might not lead to value maximizing decisions. It does not invest in the project to give you the highest value. Am I right? So those are the limitations of the payback. Value maximization decision is like 2 projects, as I said. If you have 2 projects in front of you, the first one, both of them initial investment $10. The first one give you $10 cash flow in year 1, $2 cash flow in year 2, that's it. The second one give you $2 cash flow in year 1, 1,000 cash flow in year 2. According to payback, which one should you go for? The first one, right? But according to value maximization, which one should you go for? The second one. So payback may not lead to value maximization. But still, as I said about the limitations, one of the reasons is because you may have to meet your debt obligation in 1 year's time. Okay? Now, based on the limitation of payback, given the nature of this method, apparently there are a few limitations we are not able to overcome. For example, we can't do anything about cash flow after payback. For example, we can't do anything about the cutoff period. But we do able to overcome one of the major risks, one of the major limitations, the risk. The payback do not consider time value of money and the risk factor. To this end, let's work out a discounted payback. So what is a discounted payback? Very easy to understand. Discounted payback accounts for the time value of money. In short, instead of using cash flows, nominal cash flows, now let's consider the time value of money. We cannot simply sum up the cash flows. We need to work out the present value of each of your future cash flows, and then sum up the cash flows, and then work out the payback. Does this make sense for you? So for payback, what we did, initial investment $10, year 1 cash flow $1, year 2 cash flow $9. Okay, payback is 2 years. But we simply sum up year 1 and year 2 cash flows. We can't do this because it does not consider time value of money. For discounted payback, what should we do? We need to discount year 1 cash flow to time 0. We need to discount year 2 cash flow to time 0. We need to discount year 3 cash flow to time 0. And then we work out the payback. Does this make sense for you? And that's discounted payback. You simply need a discount factor. So what should we do? Apply the discount rate. Discount rate capture risk and time value of money. Apply the discount rate to cash flow during the payback period. If your project is financed by equity, the discount rate is your cost of using equity. This method, yes, it considers the risk factor. Unfortunately, it still ignores the cash flow after payback. Now, let's see the project. We still start from Western Europe. For the Western Europe, let's see what's going on here. Here is your cash flow. Let's assume your discount rate is 18%. If your discount rate is 18%, you have 5 cash flows, am I right? Are you able to apply whatever you've learned in week 2 to work out the present value of each of the cash flow? In week 2, we learned how to do present value, right? Present value discount the future value by the discount rate. For the first cash flow, you discount it by 1 year. For the second cash flow, you discount it by 2 years. For the third cash flow, you discount it by 3 years. Fixed cash flow discount by 5 years. To this end, in the third column, you will have 5 discounted cash flow. Any questions up to this stage? Once you have 5 discounted cash flow, the rest of the step is exactly the same as payback. You use the discounted cash flow to work out your payback. This method is called discounted payback method. The discounted cash flow, year 1, year 2, year 3, still cumulative cash flow. Now look at the last column. The last column gives you the cumulative present value of the cash flows. Question: at the end of year 4, how much is your cumulative present value of cash flows? 248.8, right? Do you have enough money to recover your initial 250 million? Still not enough. But we do have enough in year 5, right? To this end, let's apply the same method. The payback will then equals to 4 years, number of years before you fully recover your cash flow, plus remaining cash flows, 250 minus 248.8, which is 1.2 million, right? Divide by the amount of discounted cash flow in year 5, 76.5. Am I right? To this end, it will be 4 plus 1.2 divided by 76.5. And that will be your discounted payback. Just 1 second. And your discounted payback, in this case, will be 4 years or 4.0157 years. Yes, what's your question? Okay. And that's your discounted payback for the Western Europe project. If the cutoff still 2.75 years, again, you reject this project because it takes you much longer to get your money back. Does this make sense for you? Now, in this method, it's applied the same intuition as the payback, but we now consider the risk factor. That's it. And that's the discounted payback. Okay? You may be wondering, hey Robert, what about the second project? Similarly, let's work out the discounted payback. And similarly, we use the same discount rate. And similarly, in column 3, you have the discounted cash flow for each year's cash flow. And similarly, in the last column, you have the cumulative cash flows. Now, in the last column, for the cumulative amount of cash flow, initial investment 15 million. At the end of year 3, do you have enough cash flow? At the end of year 3, do you have enough cash flow? No. Then what should you do? You probably need for another year. Now, the discounted payback in this case will then equals to number of years before you fully recover your cash flow, 3 years, plus the remaining amount of cash flows, 50 million minus 46.3, divided by the amount of cash flows in year 4, the discounted cash flow, which is 15.5. And then you will have your discounted payback. Any questions about this method? It's very easy to calculate. Any questions? All right. To this end, you will have a cut of 2.75 years, but unfortunately, according to the discounted payback, we have to reject this project as well. Up to this stage, any questions? To this end, if you use payback, a discounted payback, you have to reject both of them. Okay? And that's basically everything about payback and discounted payback. As I said, this method, it is very simple in practice. And frankly speaking, discounted payback is not as popular as payback because one of the major limitations of payback is easy to use. If you discount it, it's not that easy. Plus, if you discount it, you may need to use other methods. All right? I know this method is very simple, but this method is very practical for most of us. Even you do not have budget constraint, even you do not borrow money from the bank, you still need to consider the payback. It is very important for you to consider this. Okay? Up to this stage, any questions? Yes? Yeah. I have no idea. No, there's no rule of thumb. Generally speaking, as short as possible, as soon as possible, but I have no idea what is rule of thumb. There's no such a thing. As I said, there's many, yes, as I said, many factors determines your cutoff. One of the major factors, what I believe, is your debt obligation. But for different companies, you may have different debt obligation. It's really hard to say. But in most of the case, debt obligation is very important. You have to meet your debt obligation. If you have to repay the money to the bank in 3 years' time, you have to set up your cutoff within 3 years. That's it. But if you don't have this kind of pressure, if you fully finance from equity, you may have a longer payback. Okay? We do not consider this. We do not consider it's just like how long we get your money back. Yeah, we do. But that's if this is the case, it's compounding things, but we do not consider this. Okay? Any other questions about payback? If no, let's move to the next method. All right? The next method is very funny. The next method is called accounting rate of return. Now, accounting rate of return, apparently this is an accounting method, right? And some of the students may be asking, hey, Robert, why we use an accounting method? Again, accounting rate of return, there's one of our major advantage. Simple, and most importantly, it is very easy for you to get the number. It is very easy for you to get the number. Why? Think about it. For most of the company in the market, not most, for every company in the market, you have to prepare your financial reports. Am I right? Which means preparing accounting financial report is a must, which means you must have all those accounting numbers. Does this make sense for you? Which means you don't have to estimate something. About accounting number, since you must prepare accounting reports, all you need to do is to grab the number from the report, that's it. But if you want to use other numbers like estimated cash flow or something, you have to use, or you have to prepare it by yourself. You have to prepare it like estimate it on top of the accounting report, financial report. To this end, accounting rate of return, one of the major advantage, easy, and it's very easy for you to grab the information. Now, how are we going to do with the accounting rate of return? The accounting rate of return can be computed from available accounting data. Accounting rate of return is equals to average profit after tax divided by average investment. I will explain the both numerator and denominator. Okay? Average investment denominator is very easy to understand. Average investment denominator is simply equals to the total amount of investment divided by 2, beginning and ending. If at the beginning I invest the project $10, the average amount of investment will be 10 divided by 2. That's it. And no time value of money. Accounting, they do not consider time value of money anyway. So that's it. But we need to focus on the average profit after tax. What should we do? Now let's look at the first one and the numerator. The accounting rate of return only need profit after tax and depreciation. And in this example, you may not able to tell the advantage of this method, but in practice you will, because all those numbers are very easy to get. And that's the major differences. In our example, you may not able to tell because we give you all the numbers. You may think this method looks stupid, but in practice it's entirely different because all those numbers you can simply grab it from your financial statement, which you have to prepare anyway. The average profit after tax are estimated by subtracting annual depreciation from the annual operating cash flows. Now let's work it out. First of all, I want to introduce you with an idea that is what is depreciation and how to do annual depreciation. In finance, we are different from accounting. In finance, we calculate the depreciation by using straight line method only. What is straight line method in finance? Depreciation simply equals to the total amount of investment divided by the useful life of the project. That's it. Some students come to ask me, hey Robert, do we need to consider the residual value of the investment? No, in finance we ignore the residual value because we consider it separately. For depreciation, all you need to do, very easy. If your initial investment is $10, the project lasts for 5 years, your annual depreciation will be 2, that's it. If your investment is $20, the project lasts for 2 years, your annual depreciation will be 10, that's it. Amount divided by number of years, that's it. Okay, very, very easy. All right, I'll talk about more about depreciation next week. Now, let's see how do we do the accounting rate of return. Again, let's start from the annual depreciation for the Western Europe project. We have 5 years project, and your initial investment is 250 million. Am I right? Your initial investment is 250 million. How long is your useful life? Very good. 5-year useful life, then how much is your annual depreciation? 50 million, am I right? To this end, you know your annual depreciation. Now, you know your annual depreciation, but for accounting method, we need accounting profits. For accounting profit, it's equal to your cash flow minus annual depreciation. Do you know the cash flow? It's given, right? Let's work out your accounting profit, which is named as net income. Accounting profit and net income, they are the same, okay? Let's work out your net income. For first year, you will have negative net income because your depreciation is more than your cash flow. Do you agree? And then you take out depreciation every year. Can you see that in the last column? You will have a net income. How many net incomes? 5 of them, right? 5 net incomes, 5 accounting profits. Question. What is your numerator? Average accounting profit after tax. Am I right? We do not consider tax in this example. We need average profit. 5 profit. How do you calculate your average profit? Sum them together divided by 5. That's it. That's your numerator. To this end, your average profit will then be, you sum them up and then divide by 5, $66 million every year. Any questions? Accounting rate of return, the numerator, 66 million. Now, did I told you guys how to work out the denominator, average investment? Beginning plus ending divided by 2. Ending always 0. How much is your initial investment? How much is your initial investment? 250 million, right? Your initial investment, 250 million. Your ending investment is 0. How much is your average investment? 125 million. Do you agree? Numerator, 66 million. Denominator, 125 million. Are you able to work out your accounting rate of return? Can you do that? Which is 30%. Oh, sorry, not 30%. Which is 52.8%. 66 divided by 125. Now, assume that you have a targeted accounting rate of return, which is 30%. And this figure may be prepared by your accountant. To this end, you will have your accounting rate of return, which will be 52.8%, which is higher than your targeted rate. So what should you do? You accept this project. As long as it is higher than your targeted ARR, you accept it. Any questions up to this stage? Let's move to the next one. By applying the same method. Question, how much is your initial investment? 50, right? How many years? How much is your annual depreciation? That's it. Are you able to work out your profit for each year? Cash flow minus depreciation. In the last column, once you have profit after each year, or for each year, are you able to work out your average profit? Which is divided by 5. And by doing this, what happened? Your average profit after tax, it will be 15.4. Do you agree? And that is your numerator. And this is your numerator. What is your denominator? Average investment. 50 beginning plus 0 divided by 2, which is 25 is your denominator. Now, how much is your accounting rate of return? It's about 61.6%. Again, it's higher than your targeted rate. So again, you accept it. So based on accounting rate of return, it looks like you're going to accept both of them. Of course, it's a rate of return method. If you only compare the rate of return, you go for the higher one. But as you can see, the higher one might give you lower total amount of cash flow. It's just a percentage return, right? But that will be a question we discuss later. But that's it for accounting rate of return. Can you do it? Can you do this method? Now, in your textbook, there's descriptions about the accounting rate of return. You may want to read this as well. But let me ask you a question. In your opinion, what are the major limitations of this method? What are the major limitations of this method? Very easy. Huh? Is what? Time value of money. All right, risk. It does not consider time value of money, right? Other limitations about this method? It is a percentage return. If it is a percentage return, do you guys still remember my example? The scale of the investment. Dollar return versus percentage return. Sometimes percentage return is not everything, right? So that could be a limitation as well. But of course, accounting rate of return, it is very simple to apply. Now, with all the due respect, accounting rate of return is one of the very useful practical methods in practice as well. The reason of this method is practical is simply because of this method, you will have all those accounting information from something you must prepare anyway. In contrast to other methods, you need to estimate cash flow. Payback and other methods, you always need to estimate future cash flows. And that takes something else, takes other skills. Up to this stage, any questions? Yes. Well, it's really hard to say. Why can't you use this? I'll talk about all those techniques at the end of the class. In this week's lecture, I will teach you 6 different methods. In practice, none of the companies using individual method to make decisions. In most of the case, they will use many different approaches. Even some companies using approaches we didn't cover in the class. And they have to make decisions based on all the outcomes of the approaches. They have to consider many factors. Like I said, payback is one of the most important factors everyone needs to consider. It is very simple, yes, but it is very critical. No matter how large is your profit value, or is your value of the project, you have to consider payback. It's like today you invest $10. In 100 years' time, I'll give you 1 million. It is pointless. Your company can't last for 100 years. Okay? In this case, no matter what kind of method you are using, the value of the project will be good. But the question is, can you last for 100 years? Does this make sense for you? It's like today, if you give me $10, in 100 years' time, I'll give you $100. What's the point? All right? So that's the reason. We have to consider all those kind of factors, not to make decisions based on only 1 or 2 decision rule. There's one of the major limitations of this method. By using my example, you may not be able to tell because I give you all the number. But in practice, you will be able to know. If you're working for a company, it is very easy for you to make a first step estimation just based on accounting number. Because all you need to do is to grab your accounting report from your accounting department and get the profit number. What is your projected profit next year? They will give you a number. What about last few years? They will give you a number. That's it. But if for cash flow, you have to make reasonable estimation based on by yourself and collect information by yourself. Okay? All right. We've covered 3 methods up to this stage. Any questions? Let's move to the last one, the most important approach in finance. What we believe is the best one. It has its own limitation, but it's probably the best one. In fact, this method, we've learned it in the past 6 weeks. In this week, we just put it all together. This method is called net present value method. Now, let me ask you guys a question to recall what we've learned in week 3 and week 4. In week 3 and week 4, we've learned about valuation. Am I right? Valuation. Value an asset. Value a project. If you want to value a financial value an asset or value a project, the value of the asset or project is simply equals to the present value of all of its future cash flow. Do you agree? The true value of any underlying financial asset is simply equals to the present value of all of its future cash flow. Am I right? Now listen carefully, my example. On one hand, I know my initial investment. Let's assume it is $20. And then, on the other hand, I have the future cash flows of this investment. By discounting the future cash flows of the investment, I have the present value of all of the future cash flows. Am I right? I sum it up. I will then have the true value of the project. Do you agree? Let's assume I sum it up, the true value of the project is equal to $22. My initial investment, $20. The true value of the project, $22. The difference is $2. What should I do? Should I invest? Yes or no? Yes, right? What is this $2? This $2 is named as net present value. That's it. That's everything about the net present value. Does this make sense for you? Net present value is the net difference between your initial investment and the present value of all of your future cash flows. As long as it is bigger than 0, which means your investment will generate more cash flows in terms of present value than your initial investment. Of course, you agree. Does this make sense for you? So step 1, your initial investment. Step 2, present value of all of future cash flows. Step 3, sum up. Step 4, you have net present value. Step 5, as long as it is bigger than 0, you accept it. That is net present value. Let's look at the slides step by step. In this slide, CF means cash flow. Now, cash flow 0 means your initial investment. Your initial investment cash flow 0, normally negative because it's a cash outflow. Start from cash flow 1 to cash flow n is your future cash flows. Cash flow 1 to cash flow n, discount each of them one by one, sum it up. It will be the value of the investment. Do you agree? Am I right? The value of the investment takes out initial investment, it will give you net present value. Net present value equals to the present value of all of the future cash flows minus initial cost. Present value of all of future cash flows is the true value of the project. If it is more than how much you need to invest, it gives you positive value. It increases the shareholders' wealth. It increases the company's value. It increases the company's wealth. You accept it. Does this make sense for you? And that is the net present value method. For this method, as long as NPV bigger than 0, you accept it. For this method, apparently, we need to make or determine or measure or estimate the discount factor risk. How? If we are talking about one underlying financial asset, we are using the method we learned last week to work out the risk. For example, what is the net present value of a share? Okay, your initial investment is the amount of money you purchased the share. The true value of the share is the present value of all of its future cash flows. For example, your assignment 2, Golden's model, right? What is the discount factor? Risk, systematic risk. We learned last week how to measure it. You pull it all together, you work out net present value. If the value of the share, true value, is higher than the money you spend, you buy it. Otherwise, you short. That's it. Intuitively, if you talk about a project, you can work out present value of the future cash flows of the project. Based on the cash flow movements, up and downs, you can work out the volatility, standard deviation, and systematic risk. And to this end, you have initial investment, you can work out net present value. That's it. And that's what you learned in the past 5 weeks. And that's why I told you, for this unit, our knowledge is like we build up a building. It starts from fundamentals, and we apply the knowledge we learned before to finalize the building. All right? Let's see one example, and I do have a question to ask you before the break. Now, please note that the most important factor of this method, as we all know, a key input is the discount rate. The discount rate represents the minimum return that project must earn to satisfy the investor. If your project, for example, listen carefully, if your project is fully financed by equity, which means your investor are shareholders, you. If you are the shareholder, you have your expectation, right? Your expected return is my obligation as a manager. I have to set up a discount rate to meet your expectation. This discount rate R here is then named as cost of using equity. It's equals to expected return of shareholder. Sometimes it's also named as the required rate of return. That's why it's all interchangeable. To this end, R, the discount rate here, it varies with the risk of the firm or the risk of the project. If you are the shareholder, by investing in different kind of business, you will have different expectation. That's why R is different. If you are investing your business or your money into a banking sector, of course, you are expecting a lower return. Of course, I will have a lower cost of equity because I have a lower obligation to meet. Am I right? If you are investing your money into a mining sector, of course, you will have a higher expectation and have a higher risk, and I will have a higher cost of equity, higher discount factor. That's the whole logic. That's how to link everything together. At this stage, any questions? Students always come back to ask me, hey, Robert, why are sometimes named as discount rate? Because it's a discounting process. Why it is expected return? Why it is cost of equity? Because they are interchangeable, just different perspective. All right? In this unit, you can simply assume they are the same. In practice, they are slightly different because For example, tax factor could be one factor. From shareholders' perspective and company's perspective, you have different tax rate. So the discount rate could be different. But we just simply assume it together, all right? Ignore these slight differences. Up to this stage, any questions? All right. Let's see one example, and then we have a break. Maybe this one is the example. So for this slide, you can read it by yourself about how we determine the discount factors, all right? It's like what we've discussed. But I want to give you this example about Global Untethered and the two projects from Global Untethered, West Europe and the Southeastern Australia. Now, let's assume the discount rate is 18%. As you can see, this is your cash flow timeline for the West Europe project. Initial investment, 250 million. And then 135 million, 80 million, 130, 160, 175. Are you able to work out the discounted cash flow for each of them? Are you able to work out the present value for each of them? The present value for each of the cash flow to time 0, all you need to do is to discount each of them one by one, respectively. Am I right? To time 0. And then you have 5 cash flows. Once you have 5 discounted cash flow, present value, you sum them together. You sum them together, and then you minus the initial investment. And then you have a net present value. How much is it? 75.3 million. That's the net present value. It is bigger than 0, which means by investing into this project, the value of the company will increase. What should you do? According to the NPV rule, we accept it. Am I right? What about the Southeastern Australian? Similarly, we can discount each of the cash flow of the Southeastern Australian one by one as well. And then what should we do? We discount each of them one by one. We sum it up. We take out initial investment. We have NPV, 25.7 million. Any questions about how we work out NPV? That's what you should have known in week 3 and week 4. All right? Discount each of the cash flow one by one, sum it up, then minus initial investment. Again, it is positive. Then what should we do? According to the NPV rule, you need to accept this one as well. Up to this stage, any questions? Now the question is, it looks like, hey Robert, both of the projects with positive NPV, but if they are mutually exclusive, what should we do? If you have enough money, you should accept both of them, because both of them have positive NPV. According to NPV rule, if you have enough money, you accept both of them. But what about if they are mutually exclusive? You may need other methods to help you make a decision. Am I right? Possibly, we probably need a percentage measure. And that is something we need to talk in the next half of the seminar. Up to this stage, any questions? Before we have the break, let me ask you one question. Now, listen carefully. NPV decision rule is, today, if a project gives you NPV is bigger than 0, you accept it, right? What about today if I have an investment? Give me of an NPV of 1 cent. Is it a good project? Should we accept it? Or in your opinion, is indifferent? I repeat, what about today there is a project that gives me an NPV of 1 cent? See, for example, if you're working on campus, you see 1 cent on the floor, are you going to pick it up? Sometimes probably even not, right? But what about if a project gives you an NPV of 1 cent? Is it a good project? Are you going to accept it, or you think this is indifferent? I'll come back to that question, all right? Let's have a break, I'll come back. Think about it, all right? So please come back at 20 past. We have 11 minutes break, all right? Or 12 minutes break. Come back at 20 past. Yeah. Expected return. Expected return. So expected return is from shareholders' perspective. Your expectation about your equity return, right? Your expectation from company's perspective is my obligation. It's my required rate of obligation to meet. So it's same as required obligation. It is also same as cost of using your money, cost of equity. That's the same. That's why they are the same. Yeah. Yes. Can you assume in terms of yes, make your justification. Yes, but just make sure that you state in your assignment. So we assume it's step in the middle. It's up to you. You just need to tell me that that's your assumption. If you can give me like one or two sentences, that's your justification. Why is it needed? You can see that I know that things may take like different time or some, but however, it's in terms of we make this kind of information because we believe things have capacity sometimes it's a little bit information. But you can make this assumption for sure. Again, this is up to you. You can use mathematical average, you can use your mathematical average, you can use regression. This is up to you. But you probably give me a little bit justification about why. Yeah. No worries. All right, let's start. Okay, let's start. All right, before the break, I will ask you a question that is, if NPV is only 1 cent, what do you think about this project? Is it good? Or is it acceptable? Should we accept it? Or you think it makes indifferent? It's good? How do you guys think? It's more than 0, so according to decision rule. How do you think from the back? Think. Huh? Why is this anything to do with portfolio? Very good, yeah. Okay. Why do you think it is good? But you have to give me a reason, right? Okay. This is a good project, as what he said. This is a very good project. Why? How do we work out NPV? When we work out the NPV, we discount our cash flow. Am I right? How do we discount our cash flow? When we discount our cash flow, we are using the discount factor. Am I right? The discount factor is your shareholders' expected return. What does that mean? It means as long as your NPV is positive, even it is only 1 cent, it means at least this project meet your shareholders' expectation. Am I right? It means at least this project meets shareholders' expectation. And that's why it is a good project. Okay? Let's see more example about NPV. Before the break, we talked about these 2 projects. The first one gives you 75.3 million. The second one, 25.7 million. Now, assuming Global Untethered uses 18% discount rate, NPVs are Western Europe, 75.3 million, Southeastern Australia, 25.7 million. Should we accept the first one or both of them? Well, if possible, accept both of them. If you have to choose one, looks like you're probably going to accept the first one. But there might be other factors we need to consider. I will come back to this question. Another example about NPV. NPV is one of the most important topics for this unit. I can guarantee you that in your final examination, you must have an NPV question. All right, that's something I can tell you. But of course, it won't be that easy, all right? You may need to combine whatever you learned this week and next week to do the question, okay? Now let's say a project requires an initial investment of 300,000. Expected future cash flows are 50,000 year 1, negative 60,000 year 2, 80,000 year 3, and cash flow in at the beginning, cash flow at year 4 is $200,000. Discount rate is given. Should the project be accepted? What should you do? For this project, do you know initial investment is given 300,000, right? You have 4 cash flows. Do you know discount rate? Are you able to work out the present value of each of them? Can you do that? Are you able to work it out? To this end, are you able to work out the present value of a cash flow? Are you able to work out the NPV? So we discount each of the cash flow one by one, and then we take out initial investment. We will have NPV. So discount each of the cash flow by its discount factor respectively, and then take out initial investment. How much is the NPV? Negative 1, 3, 4, 9, 3, 8. What should we do? We should reject the project because the NPV is negative. All right. In sum, what are the advantages of NPV? What are the disadvantages? NPV in practice is well considered as the gold standard of investment decision rules. NPV, the key benefits include it considered and focused on cash flows, not accounting profits. It also makes appropriate adjustment for the time value of money and risk factors, right? And finally, it can properly account for risk differences between projects. So you can consider the project across different industry or different discipline because it adjusts the risk and time value of money. And that's the most important advantages of NPV. But of course, disadvantages. It is hard to explain because it lacks intuitive appeal of simple rules like payback. It doesn't capture managerial flexibility, real option values. I'll give you details about each of these limitations. First of all, it lacks of intuitive appeals. It's not like payback, it makes sense. If you are a financial planner, you need to explain your investment to your customer. It is very easy for you to explain payback to them because it makes sense. But for NPV, it is not that easy. Your customer must have some sort of knowledge about present value, some sort of knowledge about discount factors, stuff like this. It is truly happening in practice, believe it or not. I used to have a friend who actually opened a restaurant. The business of the restaurant is very good. So I will ask my friend, are you willing to buy the restaurant? Because he rented the location, he rented the land. I'm asking him, what about you just buy this restaurant? And he told me, I don't have enough money. I then told him that, why can't you just borrow money from the bank? He said, no, Robert, I'm crazy. I borrow money from the bank, I have to pay interest. Why am I so stupid? I don't want to pay interest. And that's their mindset. Okay? It is very hard to explain sometimes. It's not as intuitive as payback. Second, it does not capture managerial flexibility, real options. That will be discussed in next week's seminar. At the end of next week's seminar, we will talk more about real options. But just give you one more example. It does not consider real option values. For example, in practice, what most likely going to happen? If today you open a project, at at time 0, you have an estimation about cash flows of the next 5 years. That's what happened in this example, right? But in practice, most likely, at the end of year 1, you will re-evaluate your project. If at the end of year 1, the project actually have more cash flow than you expected, there is a possibility that you will choose an expansion option. You may open another production line. Makes sense, right? It's like you open a restaurant. If you have more cash flow than you expected, you may open another one. Does this make sense for you? If at the end of the year, the cash flow is less than your expectation, you may simply close the project. That's it. And those are called real options. Because in practice, managers have to make decisions based on the information they have. They have something called real options. Does this make sense for you? But NPV apparently do not consider this. All right? So it's not that flexibility. It's not that flexible. Does this make sense for you? To this end, in practice, you may need to put options into the project evaluation process, but this is beyond the knowledge of the course. Okay? So you may learn financial derivatives for more about how to incorporate options into your decision-making process. Those are everything about NPV. Up to this stage, any questions? Okay. Now, let's move to our fifth method, a percentage measure. Internal rate of return. This method is very easy to understand. Generally speaking, please look at the equation here. This is your NPV method, right? Your NPV equals to the difference of your initial investment and the present value of all of your future cash flows. Now, some students may be wondering, hey, Robert, then what is internal rate of return? Very easy. Internal rate of return, you set NPV equal to 0. Internal rate of return is a break-even rate. That is, internal rate of return is a discount rate, R, that will just give you exactly 0 NPV. Does this make sense for you? Internal rate of return is a break-even rate. This break-even rate, by using this break-even rate to discount your future cash flow, it will give you 0 NPV. That is internal rate of return. Get it? I have my initial investment $10. I have my future cash flows. The internal rate of return is a discount rate that will just give me 0 NPV. To this end, to estimate internal rate of return, all we need to do is to set NPV equal to 0. 0 NPV equal to initial investment plus present value discounted by internal rate of return, then solve internal rate of return. Does this make sense for you? Does this make sense for you? That is your internal rate of return. It is a discount rate. It is a break-even rate. The internal rate of return decision rule then is very simple. Think about it. Before you look at the slides, let me ask you a question. Discount rate is in the denominator. Do you agree? Do you agree? Discount rate is in the denominator, which means the higher the discount rate, the lower the present value. Am I right? Or the higher the discount rate, the lower the net present value. Do you agree? The lower the discount rate, the higher the net present value. Do you agree? Now listen carefully. If internal rate of return is something that gives you 0 NPV, if your actual discount rate, your real discount rate, is lower than internal rate of return, it means what? It means for this project, your NPV must be positive. Am I right? Because internal rate of return as a discount rate will give you 0 NPV. If your real discount rate is lower than internal rate of return for this project, which means you will use a lower discount rate to discount this project, your NPV must be higher than 0. Because discount rate decrease, NPV increase. On the other hand, if your internal rate of return is lower than your discount rate, which means discount rate increase, NPV decrease. Your NPV must be negative. Do you agree? To this end, the decision rule, quite simple. Internal rate of return compared to your discount rates. If your discount rate is lower than internal rate of return for an individual project, accept it. If it is higher than internal rate of return for an individual project, reject it. Does this make sense for you? Now, sometimes if you try to remember all those decision rules, it's going to be really complex. Don't try to remember it, try to understand it. Like I said, internal rate of return, okay, it gives you 0 NPV. Discount rate, increase, NPV decrease. Discount rate, decrease, NPV increase. If internal rate of return gives me 0 NPV, if I have a lower discount rate, my NPV must be positive. Am I right? Accept it. If I have a higher discount rate, my NPV must be negative. Reject it. That's it. Does this make sense for you? Now, I even have a better news for you. Internal rate of return, if you look at the graph here, horizontal axis is your discount rate. Vertical is your NPV. Internal rate of return is give you 0 NPV. If your discount rate is lower than internal rate of return, is on this side of the graph or the plot, your NPV must be bigger than 0. You accept it. Otherwise, if your discount rate is higher than internal rate of return, you reject it because NPV must be negative. Does this make sense for you? It is very similar intuitively with the NPV method, but it certainly provides you with a percentage measure. Am I right? Now, you can compare the internal rate of return across different projects. And then student may ask me, hey Robert, if this is the case, now I understand for individual project, how do I make my decision? But how do I compare two projects based on their internal rate of return? You should always go for the one give you higher internal rate of return. Why? Because the one give you higher internal rate of return, it has a higher discount rate. It can allow you to have a higher discount rate. Am I right? For example, think about it. If project A, internal rate of return is 40%. Project B, internal rate of return is 20%. If the real discount rate is 25%, for project A, your NPV will still be positive because your discount rate is lower than internal rate of return, right? 25 versus 40. But for project B, it will be negative. To this end, as you can see, the higher the internal rate of return, the higher the actual discount rate that you can use to discount your project. So the better the project. Does this make sense for you? As I told you, I have a good news for you. What is the good news? As you can see, that's how we're going to work out the internal rate of return for those both of the projects. If you want to work out internal rate of return for Western Europe and Southeastern Australia, first of all, you need to set up the equation. You need to set NPV equal to 0. You need to have all those cash flows. You then need to have the discount factors. Am I right? Do you agree? Question, are you able to work out the internal rate of return based on this equation here? Listen carefully. Just look at the equation here. Are you able to work out the internal rate of return? Without a financial calculator, you can't work it out. In practice, you can use Excel or you can use financial calculator, but without a financial calculator, you can't work it out. Of course, you can do trading error method, but it's so stupid. To this end, you are lucky because I can't force you to get financial calculator in your exam, right? To this end, I won't ask you to do any kind of calculation to calculate internal rate of return directly, like this equation here. You may have questions like this. I may give you two internal rate of return and ask you which one is the real one. You then substitute number into the equation and solve the one, give you 0 NPV. That's possible. But I won't ask you to directly work out internal rate of return like this equation here because you can't. Okay? It's just like our bound valuation question. You can't work out the discount rate. Okay? Similar or same principle. All right? But yes, we can use Excel. Excel function is just RRR, that's it. By using Excel and by using financial calculator, you can then work out the internal rate of return. For both of them, your internal rate of return, the first one for the Western Europe is 27.80%. The second one, Southeastern Australian, is 36.70%. Question. What is the discount rate? Do you still remember? What is the discount rate for this question? Very good, 18%. For both of the projects, the discount rate is 18%, which means for both of the projects, its discount rate is lower than the break-even rate. If it is lower than break-even rate, NPV will be positive for both of them. Am I right? As confirmed in previous slides. So if you treat them individually, what should you do? You should accept both of them. Do you agree? Do you agree? Second, if you only look at internal rate of return, if you want to compare these two projects, you have to select only one of them. Which one should you go for? Looks like Southeastern, because your argument will be it allows for higher discount rates. Even you increase the discount rate to 36%, it will still give you positive NPV. Do you agree? But apparently, if you recall what we discussed in week 5, Southeastern give you higher percentage return. So internal rate of return in contrast to NPV is like a percentage measure, right? But what about the scale of the investment? So that's something we need to put into consideration. Now, that's basically everything about the calculation part about internal rate of return. Before we move to the advantage and disadvantage of IRR, any questions? Any questions? Now, let's talk about the pros and cons about internal rate of return. What are the major limitations? Before that, some students may be wondering, hey, Robert, it looks to me internal rate of return and NPV does have a relationship like percentage measure and dollar measure. But intuitively, both of them consider time value of money, consider all cash flows, consider risk factors. And then some students are wondering, hey, Robert, will they give us the same conclusion? Not really. Now, when internal rate of return and NPV method agrees, first of all, for independent projects, most of the time they will give you the same conclusion. If you only consider individual projects without comparing them, you just make decisions for individual projects, positive NPV accepted, discounted lower than RRR accepted, both of the cases they will lead to the same conclusion. I said most of the case, not 100%. I will explain to you why, okay? However, you have to make sure that the cash flows are called conventional cash flows. Some students may be wondering, hey, Robert, what is conventional cash flows? It is really hard to define, but conventional cash flows is more like normal cash flows. What is normal cash flows? Normal cash flows is more like after the initial investment, all cash flows in each future years are positive. That is called conventional cash flows. So based on your estimation, after your initial investment, in future, every year you will have positive cash flow. That is conventional cash flow. I really hate the next part because it involves a little bit of mathematics, but that's okay. The conventional cash flow calculation or conventional cash flow assumption is very important. Why? Because if the cash flow is not conventional, that is, after the initial investment, if not all of your cash flow, listen carefully, is positive, sometimes you may not even have an IRR, or you may have more than one internal rate of return. And that is a mathematical issue. I will show you. Advantage of IRR, it is properly adjusted for time value of money, it considers risk, it uses cash flows. Generally speaking, advantages of IRR are exactly the same as NPV. But of course, you can argue that it is easy to read, because if you present something to your manager, percentage is always in big numbers. It looks easier, right, and makes sense. Okay? But what about disadvantage? First of all, the scale problem, as previously discussed. In week 5, you still remember, higher percentage return does not necessarily indicate it must be better. At the end of the day, you have to look at the cash flow. Am I right? Second, timing issue. For the cash flows, even they are conventional, the last one, even they are conventional cash flows, sometimes if you have a lot of large cash flows happened later, you tend to have higher internal rate of return. But these two limitations is not that hard to overcome. The major limitation is the mathematical problem. That is, sometimes you will have multiple internal rate of return and there's no real solutions. One of the critical assumptions of internal rate of return is that the cash flows must be conventional. If the cash flow is not conventional, you may have more than one internal rate of return. For one project, you may have 2, 3, 4, 5, 6 internal rate of returns. You may have no internal rate of returns, no solution. The Excel cannot solve it. There's no solution. That's possible. I will show you guys how and why. Generally speaking, this is a cash flow distribution movements if you have more than one internal rate of return. As you can see, in this plot, for this project have 1, 2, 3, 3 internal rate of returns. Because there are 3 break-even rate give you 0 NPV. Now, 3 break-even rate give you 0 NPV. 1 is here, 1 is here, 1 is here. Some students may be wondering, hey Robert, why we have so many internal rate of returns? Because mathematically, if you have multiple sign changes, cash flow sign changes, you will have multiple internal rate of return. I will explain. The rule is very simple. The rule is very simple. The number of sign changes of your cash flow equals to the number of internal rate of return you will have. Listen carefully. For a conventional cash flow, it means cash flow 0 is negative. Am I right? Because cash flow 0 is your initial investment. Then first year cash flow is positive, $1. There is one sign change from negative to positive. Listen carefully, one sign change, right? Second year cash flow, $2, no sign change, positive to positive. Third year cash flow, $3, no sign change, positive to positive. That's it. If this is the case, it is a conventional cash flow and you will only have one internal rate of return because you will only have one sign changes. Get it? What about this scenario here? If your first initial investment is negative $10, negative. First year cash flow, $10. One sign changes from negative to positive. Am I right? Second year cash flow, negative $2. Two sign changes from positive to negative. Up to this stage, you will already have 2 internal rate of return. Third year cash flow, positive again, from negative to positive. 3 sign changes. Up to this stage, you will have 3 internal rate of return. Get it? Mathematically, you will have more than one solution. And that's why. To this end, if the cash flow is not conventional, like in my example, you will have more than one internal rate of return. And the number of internal rate of return is equal to the number of sign changes. Start from your initial investment. Does this make sense for you? Huh? Sometimes, for some question and some cash flow, you may not even able to solve internal rate of return. Up to this stage, any questions? Okay, let me ask you one question. Listen carefully. This is my year 0. This is my year 1, year 2, and year 3, okay? Year 0, I invest in this project. My initial investment is negative $10, negative 10. And then in year 1, my cash flow is negative $2. So year 1, I do not have positive cash flow. Instead, it's negative $2. Year 2, positive $10. Year 3, positive $20. How many internal rate of returns for this project? How many? Let me see it again. My initial investment, negative $10. Year 1, I have a negative cash flow of negative $2. Year 2, $10. Year 3, $20. How many internal rate of returns? There's only one. Why? Because across the life of the project, there is only one sign changes. Year 0, negative, right? What about year 1? No sign changes. What about year 2? 1 sign changes. What about year 3? No sign changes, only 1 sign changes, right? In this case, you can still solve internal rate of return. You will have one of them. Get it? Good. All right, those are the limitations about internal rate of returns. Before we move to nearly the last method, up to this stage, any questions? Okay. Now, as per we discussed, for independent project, that's okay. For independent project, you can always use NPV or IRR because they share the same advantages. And as long as we are using conventional cash flow, you can work out only one IRR, so that's okay. But as per we discussed, if the projects are mutually exclusive, that's where will be an issue. If projects are mutually exclusive, NPV and IRR may give you different suggestions, like in our example. If you still remember before we break, we worked out the NPV of the first project and the second project, right? And we just worked out the IRR of the first one and the second one. Question, which one have the higher IRR? Which one? Southeastern Australia, right? Which means if you, according to the internal rate of rate decision rule, looks like the second one is better, isn't it? Which one have the higher NPV? Which means if you according to NPV rule, the first one is better, right? IRR and NPV now give you different conclusion. What should we do? You need to consider the scale of the project. If both of them are the only investment opportunity you have, you always go for the higher NPV one. Dollar is dollar, like my example, dollar percentage. At the end of the day, money is money. Get it? The Southeastern Australian have higher IRR but doesn't increase shareholders' wealth as much as Western Europe. Up to this stage, any questions? Okay. Now I have another example for you. Listen carefully. Today, I have 2 projects in front of me. I want you to compare these 2 projects. Project 1, NPV negative $10. Project 2, NPV negative $1. Which one is better? What should you do? You go for the first one or the second one? Really? Let me say it again. I have 2 projects in front of me. Project 1, NPV negative $10. Project 2, NPV negative $1. Which one should you go for? Huh? Which one should you go for? You reject both of them. All right? If you compare these 2, okay, it looks like the second one is better. But first of all, it has to meet the fundamental rule. The fundamental rule is NPV has to be bigger than 0. If it's not even bigger than 0, don't worry about it. Okay? It's like 2 bad orange. You just ignore both of them. You're not going to select the better one and eat it, right? Okay, similarly for IRR will be the same. If you compare IRR, first of all, you have to make sure both of the projects have the discount rate lower than IRR. Otherwise, it's no point. Does this make sense for you? Okay? Up to this stage, any questions? It's like 2 bottles of milk. One is expired for 2 months, another one expired for 1 week. And then you ask me which one is better. You say, okay, the first one is better, the second one is better. Are you going to drink it? No, right? So that's how you have to have this mindset, all right? Okay. Why conflict, as previously discussed? The scale of the investment is roughly 5 times of the first one, even though it is have lower percentage return, similarly. However, it will give you more like shareholders' wealth. But of course, that's only based on one condition. That condition is you only have 2 investment opportunities. But think about it in this way. If, in my example, the Western Europe is 5 times larger than the Southeastern Australia, right? If you can invest Southeastern Australia for 5 times, then you go for Southeastern Australia. Okay, because if you can bring them to the same scale, then you go for the one always with the highest percentage return. But in practice, of course, this is impossible, right? How could you have 5 same investment opportunity? So that is something you need to put into consideration. But in share market, you can do this. You just to buy the increased number of shares you're going to buy, all right? Up to this stage, we've discussed 5 different methods. Before we move to the last one, any questions? The last one is very, very easy. The last one is called profitability index. You don't have to look at the equation first. Let me just explain to you, you will understand everything. So what is profitability index? Listen carefully. How we work out NPV? This is our initial investment, right? This is the present value of all of the future cash flows, right? You take the difference. That's NPV, get it? What about profitability index? This is our present value of all of future cash flows. You put it on numerator. This is our initial investment. You put it on denominator. Instead of take the differences, you divide the value of the future cash flows by your initial investment. That's it. Does this make sense for you? Does this make sense for you? So intuitively, and estimation purpose and calculation, it will be all the same as NPV. The only difference is NPV, you take the difference. Profitability index, you divide your present value of all of the future cash flow by your initial investment. That's it. And then the decision rule is easy as well. If you look at the profitability index, on top of the equation, it is your numerator. Am I right? At the bottom is your cash flow. Am I right? Numerator divided by cash flow. And that is your profitability index. If you take the difference, numerator and the denominator, it will be your NPV. Question. If the present value of all of the future cash flow is more than your initial investment, NPV will be positive, right? In this case, your profitability index will be bigger than 1. Am I right? Because your numerator is higher than denominator. To this end, the decision rule for profitability index is very easy. As long as it is bigger than 1 for individual project, accept it. As long as it is lower than 1, reject it, because you must have negative NPV. Does this make sense for you? Any questions up to this stage? Again, the issue comes to, what about if we need to compare two projects? Again, as you can see, it is very similar to a percentage measure again, right? Again, we have to consider the scale issue. We have to consider the size of the investment. If you work out the profitability index of these two projects, as per we predicted, Southeastern Australia will give you a higher profitability index. Because in terms of percentage measure, it's always higher. It gives you higher per dollar return. And Western Europe will give you lower percentage return. And again, like internal rate of return, it suffers from what? The scale problem. Up to this stage, any questions? Do you understand profitability index now? It's not hard, right? And some students come to ask me, hey, Robert, this method looks to me 99.9% similar as NPV. Then why do we need this method? Again, as I said, think about it. It is easy to present and easy to show. Sometimes presentation, marketing is a very important factor for you to present the project. Think about it. Today, if you want to launch a property investment, you want to raise capital from the market, you want to present something. Those are your targeting customer, right? Are you want to present like profitability index like 1.3, 1.1, or you want to present a long NPV number, like 1, 2, 3, 4, 5, 6, 7, 8? So that's a reason. And it's simple to read, okay? So all those kind of factors. But you are right, it serves as similar function as NPV, but we have to consider the scale problem, okay? Up to this stage, any questions? I do have a formal example about the scale problem, but up to this stage, any questions? Okay, let's do one example about NPV and profitability index, which is not hard. Consider the following investment. The required return is 10%. If the required return is given, discount rate is given, you then able to discount each of the cash flow. For both projects, you have initial investment and you have cash flows. Are you able to work out the present value of each of the cash flow? For both projects, you need to have present value of 3 cash flows. Can you do that? you need to discount 15,000 by 1 plus 10%. Then 15,000 divided by 1 plus 10% to the power of 2. And then 15,000 divided by 1 plus 10% to the power of 3. And sum it up. Similarly, you need to discount these three cash flow. Any questions? Please also remember, in week 2, I'm not only teaching you how to discount individual cash flows. I also told you how to do something called annuity. Am I right? In this case, what happened? They are equal periodical cash flows. You can either do it one by one, or if you're good at annuity or good with annuity, you can do it with annuity as well. Okay? Let's work out the present value of each of the future cash flow for the project with annuity equation here. And then, for the first project, its future cash flows are 37303. For the second project, its future cash flows in present value are 6963. You then work out profitability index by using present value of all cash flows divided by initial investments. Question, listen carefully. Which one give you higher profitability index? Second project, right? Now, let me ask you the second question. If you look at the profitability index only, it looks like you will go for the second project, am I right? But which one give you higher NPV? NPV is the difference between present value of cash flow and initial investment. This is your initial investment. This is your present value of all future cash flow. You can work out NPV directly, am I right? Which one give you higher NPV? The first one, right? This will be our last example about the scale issue. You can read these slides by yourself. I will quickly go through it. It's just like my example in week 5. Project 1 give you an NPV of 7,300. Project 2 only give you an NPV of 1,960. To this end, let's assume both of them, you only have 2 investment opportunities. If you only have 2 investment opportunities, now you have $30,000 in your pocket. If you invest in project 1, at the end of the day, you will have $37,303, right? But if you invest in project 2, you only take 5,000 out and then get 6,900 back. And put together in your pocket at the end of the project, you will only have 31,000 something. At the end of the day, it looks like the scale matters. Yes, project 2 give you higher per dollar return, but the scale matters. Does this make sense for you? In practice, please always remember this. In practice, it is very easy for us, for most of us, to have a higher return for very small project and investment. But it's very hard for you to have high return for a large scale of the investment. Does this make sense for you? But it is unfair for you to compare a return of a small project with the return of a large project. You have to consider the scale issue. Okay? Any questions up to this stage? All right. That's basically 99% of the things we need to cover for this week's lecture. I want to conclude this lecture with this graph here, the CEO survey evidence. We've learned a lot of things this week, 6 different techniques. Well, you can actually consider payback and discounted payback as one of the same methods as payback. Now, most of the students may be wondering, Robert, in practice, what are the capital budget techniques that are applied by CEO? What are the methods that they always use? As I told you, none of them that only using one of the methods. They're probably going to use multiple methods to make their decision. But let's see the popularity. All right? Now, for this CEO survey, what are the popularity? Basically, that is for internal rate of return. Internal rate of return, for whatever reason, it is very popular in Australia and USA. And then you have net present value. And then you have payback, and real option, and account rate of return. Real option I will discuss next week. As you can see, NPV, internal rate of return, and payback are very popular in practice. Can you see that? And payback, for whatever reason, I don't know why, is very popular in UK. Payback is have a dominant position in UK. They're probably not good at math or something, but I don't know. But that's what happened about all those methods. Okay? So those are the reasons and survey. In short, learning outcomes of this week. After studying this week's topic, we talked about capital budgeting. I tried to pull everything together. And then we tried to work out the payback, NPV, IRR, profitability index, and the current rate of return for all the projects. In this week's topic, I tried to make it as simple as possible by presenting those methods to you. So I hope you have a better understanding about each of the approaches. And in this week, for NPV and discounted payback, at least as you all know, and IRR and profitability index, we need to discount cash flows. To this end, we know the discount factor, all right, we learned it last week and the week before, risk, right? But what we don't know, and students always come to ask, Robert, you talk about cash flow, cash flow, cash flow. You need NPV, you need cash flow. You need payback, you need cash flow. You need IRR, you need cash flow. What should we do about cash flow? Next week, we will teach or we will learn how to calculate cash flow and how to estimate cash flow. So next week, we will spend the first half of the seminar on cash flow estimation. We then bring everything together. We need to estimate cash flow step 1, together with discount rate step 2, and then together with NPV method, and then make your decision. Like an entire scenario, pull everything together. And that's basically everything about your capital budgeting. All right? That's it for this week's topic before we move to the workshop. Up to this stage, any questions? Again, all those things sounds easy. I'll tell you something. When you study payback, I'll ask you, do you think it's easy? Most of you guys laugh at me and say, this is so easy. The payback, what I realized in the final examination, when I am giving students a discounted payback question, the marks of this question is unbelievable lower than my expectation. To this end, it always needs practices. Practice, practice, practice. I was talking to a colleague, or my accounting colleague today, who's teaching financial accounting about consolidation, stuff like this. We share the same view. Accounting and finance, it is not hard at all. All small topics. But the issue is, too many of them, pieces, 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 everywhere. If you put everything together in your final examination, that's going to be something really, really hard. It's not like physics. Physics is like, if you understand, that's good. You can apply it on a lot of cases. If you don't understand it, sorry. You do need a level of intelligence for physics. To all due respect, right? You do need a level of intelligence for chemistry, science, right? But finance, no. You don't need a very high level of intelligence for finance at all, but small pieces. You have to pay attention on all these small pieces and put it all together. So you need practice. Practice is very important, okay? Let's do your workshop, and let's do some practice together, and see whether you are able to do it independently. And luckily, if you can probably work on your applied homework by tomorrow. Okay. And that is the first question, again from a textbook. So the company is attempting to evaluate the feasibility of investing $85,000 in a machine have a 5-year life. If you read this question, $85,000 have a machine of 5-year life. Based on this information itself, you know the initial investment, and possibly you're even able to work out the depreciation. For finance depreciation, let me say it again. Don't worry about other units. Finance depreciation, very easy. Always use initial investment divided by number of years. That's it. Do not consider the ending sale value. Do not consider salvage value because we have different treatments. The company has estimated cash inflow associated with the proposal to show below. The company has 12% discount rate. 12% discount rate. Cash flows there. Now, A, B, C, 3 things. A asks you to calculate payback and discounted payback. First of all, I want you to spend a little bit of time to work out payback. If you do have a pen and paper, try to work out the payback. I'll give you 2 minutes. Don't worry about discounted payback. All right? Try to say whether you can do payback. I want you to know how to work out the payback because as long as you know how to do payback, you should also know how to do discounted. See whether you can do it. Step 1, remember, you always need to work out the cumulative cash flow. So payback method looks easy when I present the example to you, but every year, at the end of the year, you need to work out cumulative cash flow. This will take you some time. I know it's easy, at least you think it is easy, but try to work it out, try to do it, and the practice is very easy. Right? It's not. This method in practical is quite useful as well. See, for example, at mortgage, I may need to plan for final restitution rate, right? I need to see after restitution rate. To this end, I have to have worked out the payback. If there's good investment opportunity in front of me, but I have to make sure that I am able to get my money back in 2 or 3 years' time. Because in 2 or 3 years' time, for example, if you go to primary or early school, I have to pay the tuition rate. Does this make sense for you? That's why payback is very practical in practice. Okay. For payback, first of all, work out the cumulative cash flow for each of the year. And this step may take you some time. All right, let's try to be careful about this step because most of the mistakes happen in this step. Once you work out the cumulative cash flow, hopefully your initial outlay is 85. Do we have enough money at the end of year 3? Looks like not, right? But do we have enough money at the end of year 4? Yes, we do. So number of years before you get it fully recovered will be 3. Number of years before it gets fully recovered is 3. During year 4, you need to recover 85 minus 67.5, which is $17.5 million. $17.5 thousand in that year. So you 17.5 divided by 31.5, you will then work out the fraction of the year. And the payback will be 3.5556 years. Any questions? Now, the question do not give you a cutoff period. It's only asks you to calculate payback, so you just calculate payback. If it's giving you a cutoff, you need to make your decision. Get it? The second part of your question asks you to work out NPV and internal rate of return. To work out NPV, apparently, now we need to work out the discounted cash flow. The discounted cash flow is discounted by the discount rate. You then have 5 discounted cash flow. You have 5 discounted cash flow, sum it all together, and then minus your initial investment, you will have your you will have your NPV. So 85 plus 33, and the NPV will be positive 8,672. And apparently, internal rate of return, you set NPV to 0, you solve the internal rate of return. The Excel function is very easy. You put IRR equal to Excel function is equal to IRR brackets all cash flows if you're solving for you. MTV is bigger than 0. What should we do? What should we do? We accept the MTV. Am I right? Now, question. MTV is bigger than 0. IRR is 15.58%. The question also asked you, evaluate the acceptability of the project using MTV and IRR. What recommendation would you make relative to implementation of the project? If you have such questions, you may need to state the skill issue as well. But if it is for individual project, that's okay. MTV and IRR will always give you the same conclusion, as long as they are conventional cash. That's the first one. We do have another example. In this example, it is very funny. This example, you have $10, 10 million, student 10, and must make a decision about which investment your company should accept for the coming year, using the following information on 3 mutually exclusive projects to determine which investment your company should accept. That discount rate is given. 3 mutually exclusive projects means you are only able to pick one of them. You go for A, you have to reject B and C. You go for B, you have to reject A and B, A and C. Some of the students come to ask me, Harold, if we do have enough money, how come they are mutually exclusive? Some students say, hey, Robert, look at project 1 and project 2. Both of them require $4 initial investment and $5 initial investment. Put together only $9, right? And you have $9. So you have $10. How come they are mutually exclusive? Mutually exclusive does not necessarily mean you have budget constraint. You may have human capital constraint. You may only have one team to run the project. That makes sense for you. Sometimes you may have enough money, but you don't have enough human capital to run the project. And that's why even sometimes you have enough money, they are only able to pick one. That makes sense for you. Okay. Mutually exclusive. Let's rank them based on MTV, profitability index, and others. This question is very similar to your last example in your lecture. If you work out MTV because the number is very easy, all easy numbers. To work out MTV, for the 3 projects, the first one MTV is 0.6, second one is 1.3, third one is 1.9. Which one has the highest MTV? The third one, right? But what about MTV? It looks like MTV is for the third one. Similarly, you can work out profitability index, which give you like a percentage measure. First one, 1.15, second one, 1.26, third one, 1.19. Which one give you higher profitability index? This looks like the second one, right? But then you have to make a decision. You have these 2 methods present in front of you. Which one should you go for? If they are mutually exclusive, you have $10 in your pockets, you will always go for the one that gives you highest MTV. Alright? Third one. But of course, some students, they are very creative. They asked me, hi Robert, what about if they are not mutually exclusive? If they are not mutually exclusive, what you can do, you have 10 million in your pockets. Instead of go for the third one, you can go for first and second. Right? If you go for first and second, you will have higher HB and higher profitability index than the third one. Okay? But it's not always the case. In most of the cases, we are subject to budget constraints and human capital constraints. In your company, you only have 3 employees, and these 3 employees only will do one project at one time, right? So that's projects cannot, in most of the case, are not be able to run concurrently or concurrently. Okay? Up to this stage, any questions? I'll give you tons of examples this week. As we stated, I hope you can do the practices. All right? I know that you have a lot of pressure about your assessments, assignment due on next week. Okay? But try to submit it on time. Okay? If you have any questions about your assignments, I will stay here for another 5 minutes. You can come to ask me. And also, if you need for apply for extension, something try doing as soon as possible. Don't leave last minutes. All right. Remember, provide me with some evidence documents because I need some missing documents. All right. Okay, that's it for this week's seminar, and I will see you guys next week. Okay.
But you cannot have this is called derivation, which is something which is equivalent annual value. So this is something new tax. Although for them to be compared to sometimes for but that's an assumption. But that's
Yes. In exam, you will only be examining stuff covered in the lecture. All right? Yeah. Yes?
Sorry, is it possible can we estimate, about the property?
About the property?
Yeah, I was just wondering, can we possibly estimate the price? So, if we know the growth rate for the stuff, we could, right?
I don't understand your question.
About the property pricing.
If you want to estimate property price,
Yeah, so if you know in particular area, like for example, in Berwick, if you know the growth rate.
of course, that's called property valuation. Of course.
Yeah, so we use what kind of formula we use?
I can't give you any suggestions on this. The reason is because they are using slightly different method.
Okay.
But for property valuation, we actually have the bachelor of we have a degree which is called bachelor of property. I don't remember the full name, but they are teaching you how to do property valuation.
Is it a property planner or something?
Yeah, property planning. Yeah, they actually have units teaching you how to value property. That's what they are learning because today, if you, for example, if you buy a property, every year you will receive the council rates, right?
Yeah.
The council rate is calculated based on the value.
That's right. Yeah.
And that's their job. They are valuing property. Or if you want to get money from the bank have valuer. That's their job, valuation of property. So yes, you can, but I don't know the specific techniques because they might be different from us. So it's still based on finance theory. It's based on what you learn, but we have something else. Like growing perpetuity or something, I don't know, but we must have something else.
So the components of the formula should come from like future value as well.
Yeah, of course.
So obviously,
Yes. But I just don't know what kind of components they were holding those things. They have but we have the units. We have the unit for
it's totally different. Like
property valuation is a currency is estimation, but property valuation is a very broad topic. Yes.
Okay, because I
part of your
thought we're gonna be like teaching this unit because it's a part of
this unit is more like an introduction. It's more like an introduction for everything. To give you an introduction about a little bit touch about everything.
Yeah.
And if you want to know more, you need to spend some time. Yes. Yes.
I think the battery of the microphone ran out again.
Are you sure? Yeah. I don't think so. No.
No.
No, it's there. Yeah. No, it's there.
Oh, because
I don't think so.
At the end of
If you next time you think it's wrong, I'll just let me know.
I don't want to industry.
Yeah, it's all right. That's all right.
Okay, thank you.
But it might be a little bit off. About 5 years ago. Bye.